to limit my remarks to really two brief questions. The first is, how did we get here in terms of oil markets and this oil price war in which we're seeing really a dispute between all the major producers, OPEC, OPEC plus, and then newer players into the oil market scene, including the United States. And then secondly, what are the spillover effects of both the oil price war and the COVID-19 epidemic into the region, into the Middle East, and specifically the implications for oil producers, the GCC states? So how do we get here? It's really, I think, spectacular bad timing in that the fundamentals or the structure of the oil market, I think to many of the OPEC producers, particularly Saudi Arabia, looked very similar to what they saw in late 2014, in that we saw declining demand really coming from China, and a surge in production or an increase in production, mainly from new players and shale producers in the United States. The way that that had been mitigated since late 2014 was the OPEC Plus agreement, which was made in late 2016. So since late 2016, this agreement has been in place in which Russia, as the plus of the OPEC, Mexico, and then the traditional players, Saudi Arabia being the most important, had began to cut production, which had kept prices in a safe range of about $50 to $70 per barrel, which is nothing close to that magic decade between 2003 and 2014, where we saw oil prices very, very high, between 80, 100, even up to $130 a barrel. That magic decade is very important because that's what allowed particularly the GCC oil producers, Saudi Arabia, Kuwait, UAE, to amass a large amount of savings, which they put into their sovereign wealth funds, and also funded many of the programs which we are seeing now, particularly in the Kingdom of Saudi Arabia. So in the March 5th meeting of OPEC Plus, the kind of understanding of markets was very similar to what these producers had seen in late 2014. I thought, okay, we'll just do the same thing. We will just bear it out, right? And continue to produce and starve out those new producers. And that was the Saudi strategy. Unfortunately, COVID-19 has intervened. And I do not think that there was any foresight on the part of Russia or Saudi to really take advantage of this crisis, that they could have possibly understood the demand destruction that was happening in China and then would spread to the rest of the globe, which is the reason why oil prices have continued to stay quite low. And today, Brent is about $33 a barrel. WTI, which is West Texas, is just over $26 a barrel. So very, very low prices at which these producers really are nowhere near their break-even prices. And the problem is there's no sense that demand will increase very quickly because of this pandemic situation that we are in. So what are the spillover effects of these twin crises? Looking at emerging markets generally, any kind of commodity producer, so this is, we're talking about sub-Saharan Africa all the way to East Asia, is affected right now because of the decline in global demand. We're all not working, we're all staying at home, we're all not traveling. And so when you think about especially transport demand for fuel, if normally, before our lives were changed so dramatically, we're talking about 100 million barrels per day of global demand for oil. If 3 billion people are not going anywhere, they're sitting at home, that's about and 60% of that demand is in transport. You get an idea of the impact to global demand. So emerging market, especially for oil producers, are grossly impacted, but commodity producers as well. When you look across the Middle East, what does that mean? Well, it means that tourism markets are completely destroyed. And so many of the economies of the Middle East, which are dependent on tourism, which would be Lebanon in the summer, Turkey in the summer, Jordan, Dubai as an emirate, very, very sharp decreases. And if you think about a case like Turkey, so traditionally when oil prices are low, emerging market countries or oil importers across the Middle East would get some boost from cheap oil prices. But we're not seeing that because of the overall, the lack of transportation demand and the overall demand destruction for all kinds of products. So Turkey, for example, its share of trade is about 20% within MENA, so that's a problem. Of course, any kind of exports that are going to the European Union, this means Morocco, Tunisia also also very much affected. Those economies in the Middle East that do have some manufacturing base are in rough shape. Tourism revenues for a country like Turkey are about $26 billion a year, largely earned in the summer months, which is about 3.5% of GDP. So this will be a very, very hard year for Turkey. So that means that how do countries finance that loss of revenue? They're going to need to borrow. So we're going to see a real surge into debt markets for emerging market oil importers and oil exporters in the Middle East. And this will be easier for some than others. For the wealthier states, those with higher reserves, like Qatar, can issue a $5 billion bond, no problem. But that's going to be a lot harder for weaker economies like Bahrain or Oman, or some of the other countries that are weaker in their outlook. What we're seeing in terms of the impact on U.S. shale is that there is some starving out. So we expect 30 to 40% of U.S. shale producers to go bankrupt. What's different this time than in 2014 and 2015? Shale producers were able to survive because many of them used U.S. bankruptcy courts. They got more efficient. They laid off labor. They were more flexible. And this is why we're seeing tension, particularly between the U.S., Saudi Arabia, and Russia right now, because the U.S. doesn't have the same levers in order to cut production. So I think the way we will see production come to a new normal will be, again, that some of these smaller players will simply fall out of the market because they can't afford to keep producing. And we're seeing that even in the major international oil companies cutting their capital expenditure by 30, 40%. We've seen this by Exxon, we've seen this by BP as well over the last week. Just a note on kind of state capacity, what this does for MENA governments, particularly GCC governments, is that, of course, oil exporters are very reliant on government revenues for oil. And this means that they will have less money to spend on all kinds of things, including social services. So this is a great pinch to the budgets. It also means now that the expenses of the public health sector, in Saudi Arabia, for example, even the private hospitals in Saudi Arabia, many of them are reliant on the Saudi government for payment. From the retirement fund, from the pension fund, from employees of the National Guard. And it is expected, and this happens in pro-cyclical economies of oil producers, that the government will pay late or not pay at all. And so this means that even private industries that are reliant on the government as their key customer will be in some pretty difficult financial situations. So in the healthcare system, many private hospitals, we expect to face this soon. We can go into debate in the Q&A about kind of the hope for a new agreement in what OPEC plus might look at. There are important meetings happening today in OPEC plus and tomorrow a G20 meeting where there's the expectation that there would be some agreement on stabilizing oil markets. My personal view is that the United States is an open market and should not be in the business of either threatening oil producers or telling its private companies how to behave. I believe the market will sort that out.